So I would say that probability favors the treasury market. Um, and I think people often fight the last war. So the prior stimulus we got was like Oprah. You get a car, you get a car, everybody gets a car. I think we're going to see more targeted interventions because it's much harder to do the Oprah strategy when you have super high inflation, and it's more about something breaks, you put the fire out while you're still being like, okay, we're still going to be tight, guys, we're still going to fight this, but you're still putting a fire out. Kind of like how when the repo rate spiked in 2019, it was kind of like, well, we got to put out this technical issue, but we're still, we're not in a recession, so we're not trying to go all out here. And so right now, if you look at the treasury market, it's near record levels of illiquidity. It's near record levels of volatility. And then the question is, how long can that persist, right? So if the dollar takes a break, if rates take a break, for example, maybe the foreign sector stops trimming their holdings, and maybe that can stabilize. On the other hand, if you keep pushing that really hard, if you keep, raising rates, if you keep quantitative tightening, if you keep, strengthening the dollar, and then all those other countries keep trimming their holdings or not buying or letting bonds mature off their balance sheet, that kind of thing, that puts more and more pressure on the treasury market. And so there's a variety of tools they can do. One is outside of the Fed, the Treasury Department can come in and they can do, they can do buybacks. They can buy off the run securities. They can issue more T-bills. So when you ask the question of where's the balance sheet capacity to buy treasuries, one of the answers is reverse repo, right? But it only works for shorter duration stuff. And so there's a way to get liquidity out of there and into T-bills, but that's effectively lowering the average duration of treasury debt if they do that. But that's an option that they have to extend this. Another option is that the Fed, they have repo programs in place. They could do kind of their own sort of Operation Twist or their own sort of targeted periods of time of QE if something breaks, while still keeping rates where they are. So that they have a variety of tools to, I think, assist the treasury market if it does get to the point where they need to assist it. And you can kind of be tightening on one hand and loosening on the other. And so that can still be like a net liquidity add while you still have the optics of being tight. So I think that's probably the highest probability. You can also do things like SLR adjustments so that you have the banking system buy more of the treasuries. And actually, if you go back to the 1940s, so right now the banking system in the United States has a bigger percentage of their assets are treasuries than any time in modern history. If you go back far enough, though, the 1940s and shortly thereafter, they had even a higher allocation of treasuries. So, during that whole war era, the Fed did a lot of the initial financing. They increased their treasury holdings by 10x between 1942 and 1945. But then after that, a lot of it was bank financing. And so, there's tools to then put that on the banking side. That has political ramifications, right? There's some politicians that would not be thrilled with that. And so there's a bunch of different levers that they can pull while still, retaining some degree of tightness or tight for certain things, loose for other things. Essentially tight for the private sector, but you can loosen a little bit for the public sector. And so that's something that we've not really seen over the past decade, but that you started to see. For example, Bank of England was an example of that. Higher rates, but then some degree of QE for the sovereign bond market. And so I think you could see similar things like that. Now, if they manage to avoid that, then I think it goes in that longer term thing where, U.S. government debt starts refinancing at higher and higher rates, and they're still running large deficits. So interest expense becomes a untenably large amount of the budget. And then that eventually, I think, breaks the treasury market and starts to require some sort of monetization or bank monetization, that kind of thing. There's also the fact that, private debt is rolling over. So even though we had this huge spike in mortgage rates, most people have locked in mortgages, right? So as long as you never move, as long as the economy kind of holds still, you're safe. The problem is eventually someone's got to move. They might have to, get out of their mortgage, get into another mortgage. Some people have to come in, they have to buy a house. And so eventually some of that starts refinancing. Same thing with corporate bonds, right? So corporate bond yields spiked, but a lot of that, especially the higher quality companies, they have long duration debt wherever possible. They use that opportunity to lower yields, extend their debt as much as possible, the smart ones at least. And so it's not as though all their debt has gone up to this high level. It takes time. Quarter after quarter, more of that debt comes due, and they have to refinance it at these higher rates, and that eats out of their profits, and that might make them want to streamline, might make them want to lay off some employees or slow down hiring. And so the existing tightening is already going to, quarter after quarter take its toll on part of the private economy. So there are multiple paths that can eventually cause either recession or cause liquidity conditions in the Treasury market. And at the current time, I think the Treasury market is more acutely vulnerable, but it's something I monitor on a week by week basis because this is, it's a moving game. The Treasury market is not at panic yet. So an example of not even panic, just I would call it broken, right? So broken was March 2020. That was broken, which is basically you had this, basically global trade came to a halt. Cash flows of companies dried up. They still have dollar-denominated debt. There's a huge bid for dollars globally. You had a dollar spike, and a lot of countries sold treasuries to get dollars. And so you had basically off-the-run treasuries literally went like no bid. It just was like a broken market. And so that's an example of a market breaking. But of course, there's so much breaking back then. No one was really panicking about treasuries. They're like, well, the Fed's going to fix this. But it was a broken market. And another example of a broken market is what happened to the gilt market, where you got yields really spiking, and then you would have had a cascade of pension liquidation, selling. Each one sells those gilts, and then the next one has to sell because the price got even worse, right? So you have this vicious feedback loop that basically breaks everything. So we're not there yet in the Treasury market where it's ugly and it's disorderly. But it's not outright broken, and I think part of it's because we got there at a much slower pace. Whereas what we're seeing now has taken place over the past year and a half, and so it's been this slow grind towards worsening and worsening volatility and worsening illiquidity in the Treasury market, and it's just causing problems. But it's not something that they have to put out a fire like this week. So I think it's pretty clear that they're going over 4. I don't have a strong opinion on exactly where they're going to get. I mean, if you asked me a year ago, I would not have guessed we're this high by this point. So we've already kind of gone up quicker than I would have guessed. So I would be less prone to try to make a prediction there, other than to point out that there's nothing really stopping them from getting to that point, in this environment. Because as long as they keep the Treasury market functioning through the other tools we just discussed, those other things can spike pretty high until they manifest in an obvious recession, right? So, it takes time for unemployment to happen. So the Fed's mandate is basically, they want low long-term employment, and they want price stability, which they define as 2% average inflation. And so looking at those metrics in the way that they measure them, of course, people can debate whether or not they're measuring them properly, but they define how they measure them. And Powell has a clear mandate to push up unemployment and push down inflation. And that's not going to happen next week. It's not going to happen next month. It's going to take time. And there's an argument that they've already done enough, and that they should, they were already kind of on a recessionary path now, and that maybe they should let some of the existing monetary policy take its toll. On the other hand, you have things like the Taylor rule or other sort of metrics saying, you should be at like high single digit rates. You should be above inflation, right? That's kind of how they would do it historically. Of course, that doesn't take into account the fact that most debt is insolvent at that point, including kind of the public sector, right? So I think we're in an environment where he can, the rates question, I think he's got some degree of flexibility with, as long as they put out the fires. Because if you spike rates super high, it's likely to be good for the dollar, which is likely to continue in more forward selling of treasuries. So then the question becomes, if you're supporting the Treasury market, if you're doing one hand and then tightening on the other hand, then that gives you more leeway to tighten with your one hand, right? And so I think that it's unclear how far they're going to get, but it does take time for some of these more obvious recession indicators to manifest. So I wouldn't be surprised if they get some pretty hawkish rate policies.